Alright guys, S&P 500 US stock market. It hit 5k yesterday. Why is it a psychological level? Well, if you look at a stock market moving higher, nobody's making any money. They're making unrealized gains. How do you make your money? You have to close your buy trade. If the market drops, you make less unrealized gains. So the market gets to 5k. Traders then think, well, I don't want to lose this unrealized gains because it might not get past 5k. So they close some of their trades, which is essentially sell orders in the market because you need somebody on the other side to close some of your buy trade. You're also going to get speculators coming into the market when it gets to 5k because they feel there's a good chance that the market might pull back from there. So you can see the sellers start to outnumber the buyers and then the market drops, which is essentially supply and demand. It's how every single market works. Currency, crypto, everything. Puppies during lockdown. The more demand, the more valuable something is. Stock markets are exactly the same. Why is that important to a currency trader? A new trader, you would have been through a period of success where your strategy's working well and you're making money, and then all of a sudden you go through a bad patch. And then somebody with an ego, either your mentor or some asshole in a community, will imply that it's because you're making mistakes in implementing the strategy into the market. I can almost guarantee it isn't. But a trader will then go and make mistakes and tinker with the strategy and then start overthinking, and then the trading will become worse anyway. But then when the market comes around again to being good to their strategy, they've changed the strategy, so they're not in a position to take advantage of it. So they get worse and worse as a trader, start learning more things, start overthinking, and then just everything just becomes a haze. And then they likely just give up, or they spend years of pain trying to make it as a trader. If you learn about risk, which isn't taught by any mentors or educators, because it's hard to teach and it's hard to learn. Now, if your mentor gives you something that you don't understand and it's too hard to comprehend, you're just going to leave, and then they're going to cut off the supply of their own funds, aren't they? I'll tell you what's teachable. A fib, a MACD, an indicator, price patterns, all that bullshit that's churned out by educators. It's easy to teach, it's easy to understand, it's just difficult to implement and make money long term. But if you know about risk, which you've got to put the work in to understand, money moves around the markets. If the stock market is moving in a volatile fashion, currencies are going to move as well. Now, each currency is related to a certain driver in the market, like yen to Nikkei, CAD to oil, dollar to US stocks. So if these are volatile, it's unlikely that your setups, your technical setups, are going to work. But if you're aware of the risk flows happening, then you can avoid taking the trades in those market environments, if that makes sense. You owe it to yourself to learn about risk. Once you learn about risk, you'll become a better trader overnight. Even if you don't become a better trader overnight, you'll understand why your trades are losing. And then you can create a foundation to build from and then become a good, well-rounded, safe trader.